There is a quiet mathematics operating beneath the surface of everyday life that most people never think to examine, and it works against you most precisely when you can least afford it. It does not announce itself. It does not appear in any single bill or any single moment of decision. It accumulates invisibly, compounding in the background of ordinary financial life, and by the time most people begin to notice it, they have already paid an enormous price, not because they made bad choices, but because the system itself is structured in a way that charges more for the experience of having less. This is not a story about laziness or poor discipline. It is not a motivational argument about mindset. It is something more precise than that. It is a structural observation about how modern economic systems price poverty as though it were a risk, a liability, and in some cases, a product. And once you understand the actual mechanics behind it, the experience of financial struggle looks less like a personal failure and far more like a predictable outcome of systems designed long before any of us arrived. Let us begin with something as simple as a gallon of milk. In a mid-range grocery store in a middle-class neighborhood, that gallon might cost $3.50. In a convenience store in a low-income urban neighborhood where a significant portion of residents have no car, no nearby supermarket, and no realistic alternative, that same gallon might cost $5 or more. The product is identical. The nutritional content is identical, but the price is higher precisely because the buyer has fewer options, and fewer options means reduced negotiating power. And reduced negotiating power is something that markets price automatically, without malice and without mercy. Economists have a name for this. They call it the poverty premium, and it appears across nearly every essential category of spending. Housing is where the premium becomes mathematically severe. A family with enough capital to make a down payment on a modest home might pay $1,200 per month on a mortgage, building equity with every payment, accumulating an asset that historically appreciates over time, and benefiting from a tax system that rewards ownership. A family without that capital, without the savings, without the credit score, without the 2 months of deposit typically required to enter a lease, might pay $1,400 per month in rent for a comparable space, building nothing, accumulating nothing, and remaining entirely exposed to annual price increases they have no power to resist. Over the course of 10 years, the first family has potentially built $60,000 to $80,000 in equity. The second family has spent $168,000 and owns nothing. The gap between these two outcomes is not explained by the quality of the decisions made. It is explained almost entirely by the presence or absence of initial capital. Banking is the mechanism through which this dynamic becomes perhaps most insidious. When you have money in a bank account, the bank pays you interest. Small amounts, certainly, but real compensation for the privilege of holding your funds. When you do not have money, when your balance drops below a minimum threshold, the bank charges you a fee, often between $10 and $15 per month, simply for the condition of having less. Those fees are not trivial at the margin. For someone earning $12 an hour, a $15 monthly fee represents more than an hour of labor, extracted automatically every single month for the offense of poverty. And because low-income account holders are statistically more likely to trigger overdraft protections, they are also more likely to encounter overdraft fees, which average $35 per incident in the United States. Fees which are again charged most frequently to the people who can least absorb them. The insurance market operates by the same inverted logic. Car insurance in the United States is legally required in almost every state, yet premiums are calculated using variables that correlate strongly with income, including credit score, zip code, and home ownership status, without those variables necessarily reflecting actual driving behavior or actual risk.
A driver living in a low-income zip code, renting rather than owning, with a credit score damaged by medical debt or a period of unemployment, might pay 2 to 3 times the premium of an objectively comparable driver living in a wealthier neighborhood. The math here is not punishing bad driving, it is punishing the statistical neighborhood of poverty, and it does so legally, systematically, and at scale.
Then there is the time cost, which rarely appears in financial analyses, but which functions as one of the most significant hidden taxes in the entire system. When you cannot afford a car, you pay in hours. A commute that takes 20 minutes by vehicle might take 90 minutes by public transit, and that 70-minute differential, multiplied across 5 days a week and 50 working weeks per year, represents roughly 290 hours of additional time expenditure annually. Time that cannot be spent on a second income stream. Time that cannot be spent on education or skill development. Time that is simply consumed by the friction of navigating infrastructure that was designed around the assumption of car ownership. That time has a dollar value, and when you calculate it honestly, the cost of not owning a car is not zero. It is often comparable to the cost of owning one, simply expressed in a currency that doesn't appear on any balance sheet. Credit is where the compounding effect of all these dynamics becomes most visible over long time horizons. The interest rate you are charged on borrowed money is determined largely by your credit score, which is itself a record of your historical relationship with debt, a record that tends to be most damaged precisely during the periods when borrowing is most necessary. A person with an excellent credit score, borrowing $30,000 for a car, might pay 3% interest. A person with a damaged credit score, borrowing the same amount, might pay 18%. Over a 5-year loan, the first borrower pays approximately $2,300 in interest. The second borrower pays approximately $15,000. They drove the same car. They made the same number of payments. But the system charged one person 6 times more for the identical transaction, because their history suggested they had less, and having less in a credit-based economy is priced as a form of danger. What emerges from all of this, when you place these mechanisms side by side and examine them together, is not a conspiracy. It is something more mundane, and in many ways more troubling than a conspiracy. It is a series of individually rational market decisions that collectively produce a system in which the cost of living scales inversely with your ability to pay for it. Each institution, the bank, the insurer, the landlord, the lender, is responding to genuine signals about risk and cost. But the aggregate effect of all these rational individual responses is a structural penalty on low-income households that makes accumulating capital extraordinarily difficult, not because of any single bad actor, but because the architecture of the system itself prices poverty at a premium. This is why financial education, while genuinely valuable, can only go so far when applied in isolation. Knowing that you are paying a poverty premium does not automatically give you the capital required to exit it. Understanding compound interest does not immediately repair a credit score damaged by a medical emergency. Recognizing that renting is more expensive than owning over time does not conjure the down payment required to own. The knowledge matters, but the knowledge must be paired with an honest understanding of where the structural barriers actually sit, so that the solution can be aimed at the right target. The way out of these systems is rarely dramatic. It does not usually involve a single decision or a sudden reversal of fortune. It tends to involve identifying the single most expensive premium being paid, whether that is a banking fee, an insurance rate, a rent-to-mortgage gap, or a high-interest debt, and directing available resources toward eliminating that specific cost first, then moving methodically to the next one. The financial psychology literature calls this the debt avalanche when applied to interest rates, but the principle extends more broadly. It is the practice of treating your financial life as a system to be optimized, rather than a series of isolated decisions to be endured.
What changes when you understand this is not your income and not your circumstances, at least not immediately. What changes is your orientation toward the system. You stop reading your financial situation as evidence of your character and start reading it as a map of structural pressures, some of which can be addressed, some of which require time, and all of which become easier to navigate once you can see their actual shape. The system is real, the premiums are real, and the beginning of any serious financial change is simply the moment when you decide to understand them clearly, without flinching and without looking away.